Okay, this is a video that I want to discuss some things that I have personally encountered that will substantially prolong or actually kill an acquisition. So I should also mention too, you may want to try to discuss these things ahead of time, even before you start talking about a price or how the business operates or what it does or how it functions. Some of these things you may want to go over with an owner or a seller, depending on if you're buying or selling, and might save both parties a lot of headache in the future, because I know I've had a lot of frustration, a lot of headache from some of these items that I'm going to list here. First and foremost, the honesty factor. Be totally transparent about what your intentions are with the business, right? If you're, for instance, me, I may meet an owner, we may kick it off, and he may really like me, or maybe he's known me for a number of years already. I have to be totally honest with him, like, listen, man, I'm not going to be the one running this company. I will, on a weekly basis, be looking at the financials, the process, production reports, balance sheets, et cetera, but I will have somebody in here managing this company. It will not be me, right? Because, you don't want to get 3, 6, 9 months down the road, real close to closing, and drop the ball on him like, hey, man, and he's been telling his employees, like, right towards the end, like, hey, I got a really good guy who's going to buy this company, and you're really going to like him, and you tell him, hey, it's not going to be me, it's going to be somebody else you don't even know. So introduce that right away. Whatever your intentions are, introduce it right away. Lack of succession planning. So this is big, right? These guys have been building their businesses for years and years and years. And, what was their job? Their job was to sell a good or service, whatever it was, and not think about selling their company. Maybe they were wrong in that fact, but that's just been the strong majority do not have a lot of succession planning. And I've talked to a lot of business owners who have kids, and I always ask, like, your kids don't want this company? And always the same thing. Nah, they don't want it. So I don't know. I mean, it's amazing to me, and sometimes you're like, well, I was going to sell it to an employee, but here's the bottom line. Yeah, that would be great, and this doesn't happen that often. That would be great to give it to a really trusted employee who's been there for decades, right? Yeah, a little bit younger than the owner maybe, but at the same time too, the owner wants paid. Can that employee come up with that much money, right? Does he have the means to get that financing? Does he have the money saved up, right? Is he good with the financial side of the business? So those are some things that really can, and it's like whenever they want to sell, it's like, hey, now we got to go through this whole big process. Like a business owner, it's not just like, hey, I'm going to decide to sell, so good, I'm good, I'll sell the company. Wrong. It's like, you make that decision to sell your company, then a lot of new work is about to start, sometimes for a very long time, for a couple years before you actually get to closing, right? So something to think about. The big one, unrealistic valuations in terms. How do these unrealistic valuations, and when I say unrealistic valuations, I mean like, hey, I think my company, even though it does $1 million a year in revenue and I make $80,000, I think it's worth $10 million. Well, you may think it's worth $10 million, and you as an owner can sell your company for whatever you like, but that does not mean that somebody's going to realistically buy it, right? So a lot of time it's, business brokers, they'll inflate numbers just to make sure their fees stay high. How about just uninformed people that they talk to, like, oh, their buddies at the bar? I don't know. I have no idea where they come up with some of these numbers sometimes. I have no idea. It's like, I want $5 million. Why? Like, walk me through why your business that only does $2.5 million top line revenue a year is worth $5 million. And you got 3 rusty trucks and a long list of clients. It's crazy to me sometimes. So, also, what is there to lend on? Okay, what exactly are you buying, right? So you're buying the name, you're buying the history, you're buying the processes, you're buying the intellectual property. What assets are you buying? Because here's the thing, if you don't have the money in your bank account to buy it outright, and you're using some kind of, especially conventional financing, like, you need to have assets attached to that. That means, is there real estate involved? Is there a fleet of trucks involved? Is there expensive equipment involved, right? Because the banks feel a hell of a lot better lending when they have a whole lot of tangible assets to collateralize rather than just 40 years of goodwill, right? Because you can't collateralize goodwill. You can't repo goodwill, right? But you can repo a building, and you can repo all the equipment and trucks, and they could do their best to sell it off. So you got to put yourself in your lender's shoes too. Like, hey, what do they need to see to make this work? Transition agreement from the owner. Okay, and when I say transition agreement, typically after closing, the owner's going to help you out for a few months. It's usually, you should really put it in your agreement so you understand firsthand. He's telling you every single thing about the business after you buy it, right? One thing I would suggest, be respectful, right? Yes, you are the boss now, and just because you stroked him a check and it's in your asset purchase agreement that you're the boss for the next 3 to 6 to 9 months, that does not mean psychologically a guy who hasn't had to answer to anybody for decades is just going to automatically be like, okay, you're my boss now. I'll be the employee. Like, it's I've seen it firsthand. So have some grace. Be concerned about that post-closing dance, because you know what? All that information that guy's going to give you, especially if he really genuinely cares about the business thriving in the future, like, that shit is so invaluable. Like, you can learn so much. You can learn from his mistakes. Don't learn from yours, right? And plus, too, even if he violates his consulting agreement, whatever, if it's for 3, 6, 9 months, like, do you really want to get into some kind of legal dispute after the fact? Because I've had that. I've had an owner just bounce right after. He owed me 9 months. He just wouldn't pick up his phone. Right? And it's like, it's terrible. Timeline. Try to give the guy a realistic timeline here, and it's like, hey, listen, here's some things on my timeline that can prolong the timeline. Negotiating. What do you really want, right? Let's figure out exactly how much you really want and what's reasonable and what we both can agree on, right? Is there a bank involved? Bank is going to hold things up. I'm going to tell you what, right now, especially if it's SBA, even in conventional, a bank will hold things up because they're going to want a shit ton of information, and they're going to, there's auditors, there's adjusters, there's underwriters, like that. All that stuff is going to take up time. Attorneys. Sometimes just because an attorney is an attorney, right, has the ESQ at the end of their title, does not mean that they are good at doing business closings, right? The acquisitions, mergers and acquisitions, because just like a doctor, right? There's cardiologists, there's pulmonologists, there is podiatrists, right? They're specialized in different things. Try to find out if I've had guys that I was buying their company off and like, oh yeah, my buddy from high school is a lawyer. He's helped me on different things over the years. Well, he's come to find out that guy was family law, and it was just a jumbled mess for 7 months, right? So something to think about too. And the accountant. It's insane how many people don't have their financials readily available to them at all times. Like, hey, I'll ask for something like, can I have your 3 years year to date, 3 years historicals, monthlies, year to date balance sheets, cash flow statements? And it's like, sometimes I will wait a month to get that stuff. It's insane to me, but it's realistic. You have to endure it. But like I said, maybe something to think about is telling them, is like, the faster you get me the instant information, the faster we can get through this closing. So he can put the pressure on his accountant, on his attorney to make things go a little bit quicker, all right? Because sometimes there is huge lapses in time with them. Tax returns, 3 to 5 years. Always ask for it right out of the gate. Right after I sign a non-disclosure agreement, I ask for 3 to 5 years tax returns, right? And unfortunately, the tendency a lot of the times what I see on these tax returns is break even, lose money, or maybe just like a 2 to 5% margin, right? And it's always the same thing. Hey, I got a story about that year. I got to tell you a story. And they always say, for some reason too, they're like, well, I know I'm not talking to the IRS. So like, yeah, no shit, you're not talking to the IRS. But at the same time too, like, I know what your story is. You didn't report earnings, you reported losses, you pocketed cash, right? And you didn't have to pay that, you paid less taxes than you were supposed to. And that's great. And you successfully did it for decades, right? You successfully evaded paying full tax to the IRS for decades. However, now is when you're going to pay with a dog shit valuation, because I do not go off of the word of somebody telling me, well, I usually do $400K in cash a year that I don't report. I go off of what you reported to the Internal Revenue Service every single year, right? So they either have to accept it or they find somebody else that they could trick, right? And guess what? All the better. If they are telling the truth and they are collecting $400,000 a year that they're not reporting, hey, it's a benefit to me. It's a benefit to you, right? So, okay. Here's a big one that can hold it up too, and alter the valuation is if the owner is the business of the company. If the business owner makes every single decision in every single sector of the company, nothing, he's there 7 days a week making all the calls for every single piece of the business, then he is the business, right? Like, I don't know how to say it in nice words a lot of the times too, but it's like, I'm not buying you. When you leave, I got to pay somebody $200,000, $150,000 a year to come in and make sure this thing runs properly, right? So if and I'll use this as an example. We're buying a company next week, or actually in 2 weeks, October 6th, and the owner lives 11 months out of the year in New York, and his company's here in Pittsburgh. And that is of great value to me, because that tells me that he doesn't have to be there, right? So that's an easy one. There's management in place. The company's already running, so that's very valuable to me. And I don't mind paying a higher price for a company like that, because guess what? I don't got to pay somebody $150,000, $200,000 to monitor it every day. That's something that you should think about whenever you're looking at some of these businesses. Current debt of the business, right? So obviously, an asset sale, all debt gets paid off at closing, right? But here's the thing: if they have a lot of debt, whether it be a line of credit, a lot of truck notes, general loans on the business, whatever it may be, that stuff needs to get settled up at closing. And if you're not going to use all your own cash for the business, for the acquisition, or if you're not going to use conventional financing and you're using the seller notes, well, you got to come up with all that debt right out of the gate at closing to make that legit, right? And sometimes that defeats the purpose of a seller note. Like, we want to come in with less money, right, in the beginning, and then pay in negotiated terms over the years. So something to think about. If they got a crazy amount of debt on their balance sheet, then that may kill the deal before it even starts. Government subsidies. And when I say government subsidies, it's 2025 right now. You see on a lot of these historical tax returns, 2021, 2022, 2023. What do you see? You see these line items of other net ordinary income, miscellaneous income, some other line items, but whether it be on the tax return or be on the QuickBooks income statement, it's the PPP or the employee retention credits, right? So a lot of these companies are actually losing money if it wasn't for those two things. So my opinion is you just take those out, just completely erase them from the math and pretend like they're not even there, because they ain't going to get them again. Right? If those are the only things that made that company profitable in those years, then maybe it's something you might want to walk away from, right? Cash flow, so the cash flow has to support your debt service. And when I say that, I mean what the company cash flows a month has to be substantially greater than how much it costs for you to get that money loaned to you to buy the company, right? If the company cash flows $50,000 a month, right, and then you have a big giant SBA loan that's $48,000 a month, right? That is really tight. What, you're only going to make $2,000 a month? Now, interest is only going to be on your income statement, right? But at the same time, too, I wanted the cash flow. Like, you got to worry. I mean, yes, you got to worry about your accrual accounting, but you need to worry about cash flow. It's like oxygen, just like Warren Buffett says. It's like oxygen. The minute you don't have it, you're going to suffocate. So that's something you really need to look at. Okay, conservatively look at what this company regularly does monthly, and then compare it to what your debt is, right? And obviously all your other expenses, but something that can kill the business, because a lot of the times too, like, you'll be looking through these financials of this company, and they don't have a big giant conventional bank loan or a big SBA loan attached to it that they got to pay every month, because a lot of these companies were started from the ground up, and a lot of them don't have a lot of debt. So unionized workforce, my opinion, I think there's so many companies for sale that you engaging in a unionized workforce, it's ridiculous. I don't need any more problems. I don't need any more people to answer to, right? We already have enough problems on our. It's just another factor to disrupt the business or for you to learn. Unless you already have substantial experience with the local union, trades in the area, like, hey, go for it. But at the same time too, if that's not an area that you're not familiar with, I would tread very lightly or just pass on it, because I am familiar with it, and I still pass on it, because you know what? I don't need any more pains in the ass. If I don't need to, I just walk. Complicated business or confusing financials. Again, if the company does not make sense to me almost immediately, I typically will walk. If the financials are so complicated and I can't understand them, I mean, I'm not like a forensic accountant or anything, but like, if I'm pretty familiar with regular financial statements, and guess what? If I don't understand them right away, I typically walk. If there's creative accounting and everything else, like, a lot of times it tells you all you need to know about the business. Lack of understanding from the business seller, from the business owner that you're buying a company from. Lack of understanding of the process of an acquisition. You can't fault them for that, right? Like, a lot of these people ask me all the time, it's like, okay, what do we do now? What do we do now? And it's, hey, explain it right out of the gate. Like, listen, first thing we're going to do, we're going to sign a non-disclosure agreement. That way, I'm legally bound to not run my mouth about anything that I learn about your company or you can sue me. Done, right? Then you can start getting the financials and everything else, and then you guys can agree on a price. Hey, then I'm going to give you something called a letter of intent, okay? That's going to clearly state what I am prepared to buy your company for and what I'm buying. And then after that, I got about 30, 60, 90 days to do my due diligence. And then we're going to sign something called an asset purchase agreement that solidifies everything. Money's exchanged, we close, and now I'm the business owner, and you have successfully sold a business. So, like I said, something just to go over right in the beginning, because a lot of times they have no idea about this, and I don't blame them for it. Who does? People running their mouths about this. So a lot of times this is not something that should be highly publicized whenever you're in a negotiation with a business owner. I could tell you one time, one of my masonry companies was buying out one of their competitors in the area, and we were about 4 months into the deal, and a lot of these guys, a lot of my employees at the time had worked there, and vice versa, and this and that. So it was just a competitor we were buying out. And we were pretty far along in the process of 4 months, and we were waiting for them to sign the asset purchase agreement. And for some reason, this owner just started opening up publicly about, hey, someone, he's going to buy my business, this and that. And naturally, his employees got very worried, because that can be a scary thing to an employee who has never been through a business acquisition, right, or a change of ownership. So, and then they were calling my employees were telling their project managers and their foreman, and then, they were calling me about it, and it's like, just just shut up until closing. Just keep it to yourself, or keep it to you and just your accountant or your CPA or whoever you're trusted. Is just like, this isn't like, what is it called in the office, like water tank talk? I've never worked in an office really, so I don't know. But it's like, this isn't common shit to bullshit about, right? It really cause a lot of problems, and I've seen it firsthand. It really does. So, like I said, these are all things that I have definitely encountered that caused me a lot of problems, cost me money for sure, and you know, something to maybe think about, learn from my mistakes, and try not to make them on your own. So maybe try to discuss some of these things ahead of time before you really start and get into the deal, and could potentially prevent a lot of headache in the future. But that's all I have for today.